Prologue.
The Johnson-Omega method animated in this clip was developed by Alexander Passo, and is based on the Omega method introduced by William Shadwick and Con Keating in 2002 and the Johnson distributions published by Norman Lloyd Johnson in 1949 in Biometrica. Besides LTCM crisis in 1998, investigated by the author in Risk April 2005, the Lehman collapse, studied here, was among the worst 2 months in hedge fund industry since January 1990. The clip transparently shows how, and why Johnson-Omega would have had allocated out of sample, prior to Lehman collapse, as of 31 August 2008.
Estimation page.
Monthly HFRI index data since January 1990 are used, as best understood by professionals helping to understand the nitty-gritty of what follows. Simplest estimates and free constraints in the framework of a 130-30 portfolio were applied for the sake of transparency and data mining avoidance, although even stronger results might be achieved with sophisticated factor, ARIMA or GARCH-type models or optimizing bounds. The 6 months averages prior to Lehman were already negative, indicating the presence of a downtrend. Volatility is based on past 12-month standard deviation to better account for current volatility environment. Skewness captures the direction and kurtosis the magnitude of extreme return experiences and naturally estimated on entire available history. The findings from pre-LTCM investigations are affirmed. Low volatility strategies, event-driven and relative value, have substantial fat tails towards the downside in contrast to macro with its favorable tail properties. Also, equity hedge has fat tails, but rather neutral with respect to direction. Extremely risky in any respect is emerging markets. The co-moments, that is correlation, co-skewness and co-kurtosis, are estimated on an accruing window, to capture extreme past events asset interactions. This important information is quickly diluted within correlation, but remains memorized, visible, stable and significant in third and fourth order moments for decades. The Johnson-Omega framework solves for the ambivalence or amplification between volatility, tail direction and fatness by comprehensively and non-discretionarily utilizing central and co-moments up to fourth order. The fact that noisy higher moments are endogenously determined, justified by chi-squared tests and not able to distort optimization enables the Johnson-Omega method to provide a diversification, which holds when needed. That is, in crashes. Details with respect to co-moments become transparent through expected marginal attributions analysis in an extended clip.
Johnson distribution.
The skew-kurtosis chart shows that all strategies deviate substantially from normal and log-normal distributions. In the distribution chart it seems that macro is quite risky. However, what happens in the tails becomes visible when using a logarithmic scale. Macro declines by magnitudes quicker in the downside tail despite of higher volatility. This phenomenon is captured in the Johnson-Omega framework by skewness and excess kurtosis. Chi-squared test confirm appropriateness of Johnson distributions for all strategies, therefore extended clip.
Justification of Johnson distributions.
The chi-squared test to check appropriateness of the Johnson distribution, that is affirmation that endogenous determined moments of order 5 and higher fit to data. Test successful. All Johnson errors below critical levels. Close match between theoretical and realized number of occurrences. All Gauss errors clearly exceed critical levels. Poor fit. Even worse, Gauss fit poor not only in tails, but even in the center. Hypothesis that Johnson distribution correct cannot be rejected, even at low confidence levels.
Johnson-Omega optimization.
The initial, equally weighted portfolio remains visible as shaded, while portfolio subject to optimization is represented by filled bars. It is crucial, That moment estimates 1A, capturing only economically meaningful and significant economic stylized facts and nothing more, that is, excludes implicit and explicit noise and insignificant information. Together with portfolio weights 1B. The portfolio moments 2 are uniquely determined. Those in turn uniquely determine the Johnson distribution 3, that is the dashed line. The cumulative density provides the minimum expected returns at each probability level. E.g., there is a 5% chance that returns of equally weighted portfolio in subsequent month September will fall below -4.1%. A hurdle which equals the mean is introduced. The hurdle separates the blue area from the red area. The blue area measures the upside potential, and is calculated as Johnson call. The red area measures the downside risk, and is calculated as Johnson put. The put price can be interpreted as the price of an insurance against returns below the mean. The call over put ratio is called Johnson omega, which is initially equal to 1 by definition of the mean. Please observe weights, moments, options, omega, as well as minimum expected returns, during the optimization, which will start now.
Johnson Omega optimization result.
The optimization result is as follows. Mean increased. Volatility is reduced. Thus, the portfolio improved already in the main variance, Markowitz, sharp and traditional sense. Moreover, the distribution is bended from negative skewness towards positive. Further, excess kurtosis is almost completely eliminated. As a result, the dangerous fat tail vanished, before Lehman collapse. Thus, the Johnson omega shifts and bends portfolio distribution, which becomes better in the traditional mean variance sense and furthermore has superior tail properties. Downside risk, that is Johnson put, is massively reduced, while upside potential, that is Johnson call, is increased substantially, implying an increased Johnson omega. In particular, tail risk becomes much lower, but only slightly weaker upside tail. E.g., after Johnson omega optimization there is a likelihood of 5% that returns of the Johnson omega optimized portfolio fall below -1.6%, which is a substantial improvement. Density is almost first-order stochastic dominating, that is preferable by each rational investor irrespective whether risk-lover, risk-averse, and as utility function.
Optimization minimum variance.
The minimum variance portfolio is added in orange. Expected mean is poor, due to ignorance of downtrend. Its volatility is slightly lower, but a substantial fat downside tail due to negative skewness and high excess kurtosis. Higher downside risk despite of lower volatility, which in turn destroys upside potential. Ignorance of the trend, which is one of the most stable and best understood stylized fact in Financial Times series, and ignorance of skewness and kurtosis leads to inferior portfolio.
Optimization maximum return.
The maximum return portfolio, added in yellow and incidentally equal to the optimal Sharpe, has highest expected return. It has also highest risk due to a high volatility, which is even amplified by a fat tail, due to slight negative skewness, combined with significant and substantial excess kurtosis. Downside risk increased stronger than upside potential, leading to inferior Johnson Omega. Highly risky, in particular fat tail risk to downside.
Optimization summary.
Aggregates ex-ante Lehman collapse expected performance. The table summarizes the moments, showing the superiority of the Johnson Omega optimized portfolio in contrast to its peers. The moments uniquely determine the Johnson distributions. More illuminating, in particular what happens in tails, is shown by the logarithmic chart. Johnson Omega achieves an improvement with respect to capital protection by magnitudes, as can be seen in the quick decline of the blue curve for negative returns. Overall, the Johnson Omega portfolio has a clearly better expected upside over downside relationship in tails. Economic reasoning is that the superior Johnson Omega achieved through fully exploiting long macro and short emerging market potential, by squeezing juice out of data completely and the capacity to process information rigorously. All other portfolios have dangerous fat tails, in all cases with at least a tendency towards the downside.
Realized returns.
Expectation is one thing. Realized returns during Lehman collapse another. As an LTCM crisis, the low volatility strategies event-driven and relative value suffered more than 3 standard deviation drawdowns during Lehman collapse September 2008. Macro was again stabilizing, due to its favorable distribution properties and interaction with other assets in the portfolio. Gauss theoretical frequencies deviate substantial from realized. Johnson theoretical frequencies fit quite well to realized. Johnson Omega portfolio performed best. More than one LTCM-like event was already expected prior to Lehman collapse. Obviously, Johnson Omega accounted well for rare event, asset characteristics standalone and co-movements during market dislocations. All other portfolios' volatilities did not attribute appropriate likelihoods to Lehman-like collapses, and suffered worse than 3.2 standard deviation events. The minimum variance portfolio experienced a second time an event, which was expected to happen just once in 90,000 years. Johnson Omega outperformed all benchmarks and controlled for the high-risk low-volatility strategies, by sorting the wheat from the chaff of the data, and rigorously and non-discretionarily processing economic meaningful, significant and asset characteristic asymmetry and tail fatness at arbitrary levels. Lehman collapse is just a snapshot. Backtests over entire period, that is more than 2 decades, showing that all benchmarks are persistently and significantly outperformed by Johnson Omega, are available upon request.
Summary and conclusion.
Johnson Omega accounts for economically stylized facts related to mean, covariance, skewness and kurtosis of and between assets. Able to account for each combination of asymmetry and tail fatness. Provides superior diversification, which holds when needed, by accounting for only weakly diluted central and skewness and kurtosis. Ignores and does not require other noisy estimates and calibrations. Avoids data mining as non-discretionary, as first 4 moments are uniquely and comprehensively mapped by Johnson-based formulas. Extends the theory of Markowitz's modern portfolio theory, to call put space accounting for skewness and kurtosis. Employs proprietary call and put prices in Greeks, which generalize Black-Scholes Merton to arbitrary asymmetry and tail fatness. Links intuitive and naturally both theories through put-call parity. Reduced model risk as Johnson Omega directly utilizes cumulative density. Idea is to shift and bend density to higher risk-adjusted expected returns. Consistent with traditional performance ratios. Allows higher upside potential, as volatility not discriminated per se. Risk, that is Johnson put his cost of insurance below hurdle. generates potentially first-order stochastic dominating portfolios, which are preferable by each rational investor, irrespective of his utility function. Allows to naturally include risk-free asset and optimization for an endogenous, non-discretionary determination of leverage. Naturally given hurdle, induced by benchmark portfolio, may be modified for e.g. pension funds, which must generate guaranteed returns. Allows to be applied to all kind of portfolios, e.g. long bias. Allows to optimize fast and unique due to availability of closed-form solution of performance measure. Tested practically on various universes traditional and alternative assets, liquid markets showing significant absolute and risk-adjusted net outperformance. Unified and consistent theory with further applications to option arbitrage and risk management, in particular the detection of time bombs in portfolios by employing an expected marginal attribution approach.